Greetings, ladies and gentlemen. Welcome to the Equity.Guru Investor Roundtable special edition today. Very, very special. I'm one of the many people getting his kicked in the market right now. But I'm still smiling for no particular reason. Lot happening, good and bad, much bad, or at least in recent weeks. And these three folks are going to tell you how potentially you could respond to that, or maybe how they're responding to it. It's Michelle upstairs in the penthouse with the gold. In the far corner is Fabi in Portugal, living that hot European lifestyle, like on fire. And there is Galen in the basement with me, living down here, paying the rent. Let's start with Vishal's approach, the man with the gold vault. What are you doing in this crazy, wacky day and age?
For sure, Rob. So for quite a long time, I've been doing nothing. Maybe for the past month, I've just been sitting here watching the markets. As you guys know, I have a technical analysis approach. I do favor the technicals, but of course, we will talk about the fundamentals in this video. Everything changed today. I'm happy to say that after almost a month, I've taken some longs on the markets as some trades. I'll sort of talk to you guys about why I decided to do that from a technical analysis perspective. Want to show you guys the heat map of the S&P 500 because, boy, we had a quite the strong day. The only thing that is standing out to me is IBM, which was down 5%, and Signature Bank down 4%. But other than that, green mostly everywhere. You can see some of the healthcare guys are mixed or red as well. But very strong day on the equity markets. And I've basically been watching this basing here. For the past month, we haven't really been doing much. And I call this a range. So I want to bring up this stage or this, basically an indicator of the four types of phases in a market. This dude here, his name is Stan Weinstein. He's written about this. Very good trader. His book is like from the 80s, but I highly recommend it. Really great book. He calls these stages, stage 1, stage 2, stage 3, stage 4. Very simply, range, uptrend, range, downtrend. So currently, if you apply this method, which I tend to apply to most of my charts, we're at stage 4 into stage 1, going into stage 2. So we're about to be going into a new uptrend, which actually has been confirmed today with these breakouts of the ranges on the S&P 500, on the NASDAQ, very strong on the NASDAQ, which might get buoyed by Netflix, even though they missed targets. It was better than expected, and the stock is popping, so that might be a catalyst. And the Dow Jones as well, and the small caps. We had a bit of a hint earlier on today with the European markets closing at 8:30 a.m. Pacific Standard Time. Most of them were also breaking out. So we're seeing breakouts globally, and it looks like there is going to be a new, well, I hesitate to say like a long uptrend because I think this could still technically just be a pullback in a downtrend. But as a swing trade, I think we're going to be seeing some nice green in the next few days here. And the only thing that would nullify this entire thing is if tomorrow we get a big smackdown red candle, which turns out to be some sort of fake out or false breakout technical signal that we get. So in summary, things are looking good here. However, when we bring in some of the fundamentals, I think there is some, reason to be a bit worried. And I think, Galen, you'll probably want to talk about that.
Yes, the cautious bull, which maybe describes where Fabi is sitting at this moment, even though she's looking at it from Portugal.
Yes, cautious, but only theoretically so. So I really don't know what the market's going to do in the next 3 to 6 to 12 months. And if you are with me and you don't really have a crystal ball, then maybe you should look at your own portfolio and try to decide what to do with it, regardless of what happens. And what I'm seeing when I look at my own portfolio is there are some positions that I have more belief in than I did 6 months ago. And there are some that I have less conviction in. And so regardless of the current state of the market, I'm looking at what I already own, what I like, and what I maybe don't love as much. And I have only ever really made money in two ways. One is that I got in really early, or that I bought a sector that was really cheap. And so going back to those two simple things, I am reshuffling the cards in the deck and saying, okay, why does this company deserve to own this much of my portfolio? If it doesn't, then guess what? I'm going to trim a little bit and move it to something that I have more belief in. And in that way, it makes me sleep better at night, whether price is up, price is down. If I believe in the story, then I'm going to hold.
Do you want to get any more specific?
Do you want names? Yes, I could. So quickly.
Sector or
right
name?
now, okay, everybody knows I'm very big into uranium. I guess 90% of my stock portfolio is in uranium, so I'm obviously going to talk about that. So I made, quite a good return in uranium developers. However, there are new, soon-to-be uranium developers that most people haven't heard of because they're tiny little companies that don't even have a website yet. Okay. And these are companies that I'm looking at that can quickly prove up pounds in the ground because they have historical data that isn't up to standard yet, because these are old mines from the 1950s, from the 1970s, and they can't go to the market and say, we have 10 million pounds, 30 million pounds, etc. But they know they have it, right? Because it's been mined in the past. And so I'm looking at these tiny, tiny companies that are maybe, $5 million and below. We know there's pounds in the ground, but they haven't really, their names aren't out there. And so they don't have immediate attention yet. Those are the names that are probably going to get lots of love from my portfolio from the gains that I've had in the past, starting to distribute into smaller names.
All right. I like it. A reshuffle.
Yes.
Galen, not as optimistic or what?
Well, I appreciate Vishal's argument because from a technical aspect, it does point in the direction that he is suggesting. I really like what Fabi has going on. She's being smart and trying to protect herself in a time where there's a lot of uncertainty and nobody has a crystal ball. I, however, am a little bit of a curmudgeon when it comes to things like this. I appreciate the technical argument.
Right.
But for me, many times, and it doesn't mean to say it won't happen, I feel that a lot of the technical aspects of the market are based on fleeting investor sentiment, which is not necessarily based on a lot of solid things. And for me, the fundamental analysis points in a different direction. Now, if we take the long picture, over the past 20 years, from 2002 to 2022, real production in America has climbed incrementally. Now, basically, when you look at the worth of a country and the stock market that is based therein, you're looking at GDP. You're looking at how much does that country put out? What does it produce? And that is a marginal figure as far as I said, as far as an increase is concerned. But then when you take a look at the markets themselves, in comparison, you have growth of 135% in the S&P, I believe, and 153. You know what? I'm going to cancel it. It's over 100% for both of them. It's ridiculous at this point in time. So there's a huge disconnect between the real production of the industry, and I got my numbers from the Fed, and what is actually occurring in the marketplace. Now, you may argue and say, well, then, why is it doing so well? There must be some reason. Well, have you heard about quantitative easing?
Right. Yeah,
in 2011, there was a huge push from the Fed to control interest rates, and what they ended up doing was something where they ended up buying a lot of long-term bonds to sort of show solidity in the long term and dumping a lot of short-term stuff, and that kept interest rates down. Basically what that did is it afforded people, corporations, cheap money. This cheap money got spread around pretty quickly, but the problem is in a low interest environment, the bank isn't where you're going to put it. So citizens have two choices. They buy consumer products because we're all in a land of FOMO and I want to do better than the Joneses. So they dump everything they have that's discretionary into buying consumer goods, which does drive the market somewhat and produces a sort of false sense of security. And then they take the rest and they do their best to go into the market. Corporations got all this free money, and basically what they ended up doing was doing a bunch of share buybacks, which technically mostly were illegal up until 1982, because it's, you're kind of going like, I'm just going to make myself more valuable, so it's not really a show of worth. But what it does do is it distends the market cap of the companies that do these kinds of operations. Not really a big fan of share buybacks, but whatever, they're legal at this point in time. And then they would also disperse the rest of their monies that weren't being returned into their own company for capital investment into other investments in the market themselves. And what this has done, and you'll see it in the growth of both the NASDAQ and the S&P, is that there's a huge surge in growth post 2011. Right. So again, it doesn't, and because the growth before that point was, considerable to a certain extent, but still on a meager scale compared to the hockey stick that appeared after 2011. So this leads me to believe that we've created a false economy in terms of what the market worth is. Now, you can say that, this money printing that went on during the pandemic that went out to the public to sort of the helicopter money that kept everybody alive, that's caused it. So this is all going to just be a temporary thing. Well, I don't think so. I think it was the straw that broke the camel's back. Basically, we exposed a system that was already broken and pushed it to the brink. Now, we've got lots of factors now affecting us as to how this is going to happen in the long term. We have even more inflation. At this point, between 2002 and 2022, you have inflation of 64% on the American dollar. And that was at an average of, I believe, 2.53% per year. Well, this last year, we were at 9%. And that's not showing any signs of going away in the short term. So we've got that to contend with. And any measure that the Fed takes is not going to be a happy thing for anybody. It's all going to be painful for everybody. Then we have geopolitics involved. We've got our deteriorating economic relations with Russia and China. And this is, going to skewer a lot of different individuals. You have the real estate market in China that's imploding. That's going to have repercussions across the planet. In Vancouver in particular, we have a lot of foreign investment in our real estate. And homeowners are going to get knocked all over the planet. And right now also, the canary in the coal mine, used car loan defaults are on the rise. Which is, next thing is going to be home mortgages. So for me, this is a dead cat bounce based on a desperation and, goodwill, good feeling that will disappear. My opinion. I could be wrong. It may not happen.
Just backing up Galen here, the reason why I think the markets are slightly going up higher here is because they're pricing in pretty much a recession now, which again, it's crazy, but usually bad news is now good news for the markets. But a recession would mean that this is the top now of interest rates. And because recessions are typically demand killing, a lot of people think that the inflation numbers will start to drop because people will be spending less money. I think there's like a monetary inflation side of things, which will keep inflation propped, but that's a story for another day. But the idea is here that because, actually next week on the 28th of July is when the US quarter two GDP comes out. So technically, by next week, the U.S. could officially be in a recession, which would mean that central banks would have to cut interest rates, which would then mean if you want to make yield, you have to go back into stocks because it's not going to make sense holding bonds again. So that's what the market's pricing in right now. But, Galen gave a whole bunch of cases of potential, black swan events, right? With China, with Russia. COVID looks like it's coming back too now. Seeing, things happen on that sphere as well. But there's just a lot of things that could potentially go wrong. And I don't think the markets are pricing it in. So in a very short time here, a couple sentences then, Fabi's reshuffling. You two guys are describing the overall scenario. So are you still kind of playing the market, or are you just, because we take our stocks and our companies, we evaluate them one at a time. It's just kind of more of the same though, right? Ultimately, right? Maybe it's just there's less options.
No, hold,
Just hold.
hold, man.
Just
You
hold.
can, you can hold on to the stuff that's gonna, like Fabi is doing, the stuff that's a
Yeah.
sure thing.
Yeah.
But if you're doing anything in terms of speculation and growth stock,
Tough.
I don't think so.
Don't do it.
I could be wrong, but
I think this is the ideal market to go for the good quality
Good stuff.
names
Yep.
that are popping up again and again and again, the obvious ones.
Right.
Yeah. And I think, just I guess it's sort of similar to what Fabi said, but the whole idea of looking for dividend paying stocks, in times of potential, I guess, uncertainty, because some of these companies will still typically be paying dividends. I mean, look at Warren Buffett. He's been buying a lot of Occidental Petroleum because people will always be using oil. I guess people will always be eating food as well. So, look for those type of companies. Those businesses won't get too hit hard on a recession, and, are basically staple goods, pay a good dividend. And I think a lot of those stocks are sort of a safe way to play the markets long term.
Two kinds of fuel. All right, we'll continue our market observations and our investor educations. We can't guarantee anything that we've said will come true, and I'm pointing to all three of them because they did say different things. So if you're investing or looking to invest, please do your own homework and research, because we can't guarantee anything, and past performance does not guarantee you future results. We'll see you with a few more of these kind of educational roundtables coming up, and we'll also be exploring some pretty cool companies as well. We'll see you all, including Vishal, Fabi, and Galen, on the next Equity Guru Investor Roundtable.